If you were born between 1950 and 1965, this is a direct and important update for you. New warnings linked to HMRC and official pension systems have highlighted changes that could affect how and when your pension payments are calculated, taxed, and even received. These are not rumors or speculation. These are updates tied to official systems that millions of people rely on. And the most important thing right now is this: if you do nothing, you could miss out on money you are entitled to, or face unexpected reductions. So in this video, we're going to break everything down in a simple, clear way so you know exactly what is happening, what it means for you, and what you should do next. Right now, across the United Kingdom, there is growing attention on how pension records are being reviewed, corrected, and updated. Over the past few years, official systems have been undergoing large-scale checks to ensure that everyone receives the correct amount based on their national insurance contributions. But during these checks, it has been officially confirmed that many people, especially those born between 1950 and 1965, may have incomplete, inaccurate, or outdated contribution records. This matters more than most people realize. Your state pension is not just a fixed payment given automatically. It is calculated based on your individual record, including how many years you contributed, whether you had gaps, and whether you qualified for credits during certain periods such as unemployment, illness, or caregiving. Even a small gap in your record can reduce your weekly payments, sometimes permanently. Now here is where the warning becomes serious. HMRC systems have identified that some individuals may have missing contribution years, incorrect classifications, or periods that were not properly credited. In some cases, people who should have been receiving higher payments have been underpaid for years. In other situations, people approaching retirement may receive less than expected if they do not take action in time. The key issue is timing. There are deadlines and windows that determine whether you can fix these problems. Once those windows close, your ability to correct past records may be limited or completely lost. That means this is not something you can delay or ignore. Acting early can make a significant financial difference over the course of your retirement. Another important development is related to transitional pension rules. If you were born in this specific range, between 1950 and 1965, you are part of a generation that experienced major changes to the pension system. The UK moved from the old state pension system to the new one, and not everyone transitioned in the same way. Some people were protected under certain rules, while others had their benefits recalculated under the new system. Because of this transition, many people have what is called a starting amount. This is essentially the value of your pension when the new system began. That starting amount can go up if you continue to contribute, but it can also remain lower if your past record was incomplete or if you had contracted out of the additional state pension at some point in your career. This is where confusion often happens. Many people assume their pension will automatically increase over time, but that is not always true. If your starting amount was lower than the full new state pension, you may need additional qualifying years to reach the maximum amount. And if those years are missing or incorrectly recorded, you could fall short without even realizing it. Official guidance now emphasizes the importance of checking your national insurance record. This is no longer optional advice, it is becoming a necessary step for anyone in this age group. By reviewing your record, you can identify gaps, errors, or missing years that could affect your payments. But there is another layer to this update that many people are not aware of. Some individuals may actually have the option to buy back missing years by making voluntary contributions. This can increase your pension amount, sometimes significantly. However, this option is not available forever. There are deadlines, and once they pass, you may lose the opportunity to improve your pension. This is why the current warning is so urgent. It is not just about identifying problems, it is about giving people a limited chance to fix them. At the same time, HMRC has also been working on correcting historical underpayments. In certain cases, people have already received back payments after errors were discovered in their records. These corrections have resulted in thousands of pounds being paid to individuals who were previously underpaid. But not everyone has been automatically identified. Some cases require individuals to come forward or check their records themselves. This creates a situation where two people in very similar circumstances could receive very different outcomes, simply because one took action and the other did not. Another key factor involves how pension income is taxed. Many people assume that their state pension is tax-free, but that is not always the case. While it is paid without tax being deducted at source, it still counts as taxable income. If you have other sources of income, such as a workplace pension or savings, you could cross the personal allowance threshold and become liable for tax. Recent updates suggest that more people may be affected by this than before, especially as pension amounts increase over time. This means that understanding how your pension fits into your overall financial situation is becoming more important than ever. For those approaching retirement, this is a critical planning moment. Decisions made now, such as when to claim your pension, whether to continue working, or whether to make voluntary contributions, can have long-term effects on your income. And for those already receiving payments, this is a time to review and verify. Are you receiving the correct amount? Are there any missing years in your record? Could you be entitled to more? These are not simple questions, but they are essential ones. The most important message in this update is awareness. The system is changing, records are being reviewed, and opportunities to correct past issues are available, but only for a limited time. The sooner you understand your position, the more control you have over your financial future. In the next part, we will go deeper into exactly how these pension calculations work, how to check your record step by step, and what specific actions you should take right now to protect and potentially increase your payments. Now that we understand why this HMRC warning is so important, let's take a closer look at exactly how pension calculations work for those born between 1950 and 1965, and what steps you can take immediately to secure the full benefits you're entitled to. This part will guide you through the process in a clear, step-by-step way, without using confusing jargon or technical terms. The first concept to understand is your national insurance record. Your state pension is calculated based on the number of qualifying years you have on that record. A qualifying year is any year where you have paid, or been credited with, national insurance contributions. These contributions are tracked by HMRC, another foundation for your pension entitlement. For people born between 1950 and 1965, the rules are slightly more complicated because of the transitional period between the old state pension system and the new one, which was introduced in 2016. Under the old system, your pension included two parts, the basic state pension and additional state pension, sometimes called SERPS or State Earnings-Related Pension Scheme. Under the new system, the state pension is simplified, but your past contributions are translated into what is called a starting amount. The starting amount is your pension value at the point when the new system took effect. This is crucial because it determines how much you can receive each week now, and whether you are eligible for top-up payments. If your starting amount is lower than the full new state pension, you can potentially increase it by making up missing contributions, also called voluntary contributions. This is particularly relevant for anyone who had gaps in employment, took unpaid leave, or was not fully credited during periods of caring responsibilities. To check your national insurance record, HMRC provides a free online tool where you can see every year that counts toward your pension. You can create a government gateway account and access the Check Your State Pension service. When reviewing your record, look carefully for missing years, incorrect entries, or periods where you may have been credited incorrectly. Even one missing year can reduce your weekly payment by a noticeable amount over time. If you do identify missing or incorrect years, there are ways to correct them. In many cases, HMRC can update your record once you provide the necessary proof, such as payslips, tax records, or statements from previous employers. The process can take time, so it is important to start as soon as possible. For older adults approaching retirement, delays can result in missed opportunities to increase payments. Voluntary contributions are another key tool to protect your pension income. If you have gaps in your record, you can pay voluntary national insurance contributions to buy back missing years. These contributions are not mandatory for everyone, but for those who want to maximize their pension, they can make a significant difference. HMRC provides guidance on how much each year costs and what the potential increase in weekly payments might be. It is important to note that there are strict deadlines, usually linked to your age and the year you reach state pension age. Missing these deadlines means losing the chance to improve your pension. Another factor that affects payments is contracting out of the additional state pension. Some people in this birth range may have been part of occupational pension schemes that reduced the amount credited toward their state pension. HMRC records these periods as contracted out, which can result in a lower starting amount under the new system. If this applies to you, it's vital to understand how those years were calculated and whether you have any opportunity to make adjustments. Once your record is verified and any missing contributions addressed, you will have a clearer picture of your full entitlement. At that point, you can make decisions about when to claim your pension. While you can claim from the official state pension age, delaying your claim can increase your weekly payment due to pension deferral rules. Conversely, claiming early could reduce your weekly income. Understanding the exact numbers is essential so that you can plan your retirement in a way that provides maximum financial stability. It's also important to consider the tax implications. Your state pension counts as taxable income, so if you have other pensions, savings interest, or income from investments, you may cross the personal allowance threshold. HMRC automatically includes state pension in your tax calculations, but checking your overall income plan can help you avoid unexpected tax bills. Finally, don't overlook the importance of documentation. Keeping organized records of your national insurance contributions, payslips, letters from HMRC, and any voluntary contributions you make will make it much easier to resolve disputes or verify your record if questions arise. Many older adults have discovered errors in their pension records only because they had maintained clear documentation over the years. At this point, it should be clear that this is not a small update. These are changes that could directly impact your weekly income for the rest of your life. By taking the time now to check your record, correct mistakes, and make voluntary contributions if needed, you can secure a more comfortable and predictable retirement. In the next part, we will go even deeper. We'll discuss specific scenarios that people in this birth range often face, explain exactly how much money could be at stake, and provide actionable advice on the fastest ways to ensure your pension is accurate and maximized. Now let's focus on the specific scenarios that people born between 1950 and 1965 are most likely to face with their pensions, and why acting now can make a real difference. Many of these scenarios are based on patterns identified by HMRC and the Department for Work and Pensions, and they highlight areas where small oversights can have long-term consequences. One common scenario involves gaps caused by periods of unpaid leave, unemployment, or caregiving. Many people in this age range took time off work to care for children, elderly relatives, or manage health issues. While some of these periods are automatically credited toward your national insurance record, others are not. Missing credits can lower your starting amount under the new state pension system, sometimes by several pounds a week. Over a lifetime, this adds up to thousands of pounds, making it essential to identify and address any missing years. Another scenario relates to employment abroad. If you worked outside the UK but paid into another country's social security system, you may not automatically receive UK credits for those years. However, in some cases, international agreements allow these years to count toward your pension. Failing to claim these credits could leave money on the table. Checking this early ensures you receive the full benefit you've earned. Contracting out is also a significant factor for many born in this period. Individuals who are part of workplace pension schemes that contracted out of the additional state pension may find that their starting amount is lower than expected. This is because contributions were redirected to private schemes, reducing the amount recorded in the official system. Understanding how these contracted out years are calculated is essential. In some cases, there are limited options to make adjustments, but in others, errors can be corrected once identified. Voluntary contributions remain one of the most powerful ways to increase your pension. If you have gaps in your record, even just 1 or 2 years, paying these contributions could significantly boost your weekly pension. For example, paying voluntary contributions for 1 missing year could increase your pension by over £5 per week. While that may seem modest, it compounds over decades. For some individuals, correcting multiple years could result in a difference of several £1,000s over the course of retirement. It is also important to consider deferral. If your record is complete and you do not need immediate income, deferring your pension can increase your weekly payments. Each year of deferral adds a fixed percentage to your weekly pension, which can be particularly advantageous for those with incomplete records who plan to make voluntary contributions before claiming. Tax planning should also be considered alongside these decisions. Because state pension income counts toward taxable income, understanding your full financial picture, including workplace pensions, savings, and investments, will help prevent unexpected tax liabilities. HMRC offers guidance on how your state pension interacts with personal allowance thresholds, so reviewing this early can avoid surprises. Now, let's tie this together. The warnings issued by HMRC and the updates from DWP are not just technical updates, they are practical, real-world guidance that could directly affect your financial security in retirement. The steps are clear: check your national insurance record, identify missing or incorrect years, consider voluntary contributions if needed, and plan your claim timing strategically. Acting early ensures that you maximize your entitlement, avoid unnecessary underpayments, and secure the income you have earned over a lifetime of work. This is not a situation to delay. For people born between 1950 and 1965, the window to correct records, make voluntary contributions, and fully understand your pension is limited. HMRC and DWP have provided the tools and information to take action now. By using these resources, you can take control of your financial future, increase your pension payments, and protect your retirement income. In conclusion, this HMRC warning is a critical reminder that your pension is not automatic. It requires attention, verification, and sometimes action. If you are in the 1950 to 1965 birth range, now is the time to review your national insurance record carefully. Identify any missing years, check for errors, and consider voluntary contributions to fill gaps. Understand how your starting amount was calculated, especially if you were contracted out or worked abroad. Consider the timing of your claim, as deferring can increase your weekly payments, and be mindful of tax implications as part of your retirement planning. Taking these steps could increase your weekly pension by a significant amount, secure your income, and prevent years of underpayment. The most important message is simple: awareness and timely action make a real difference. By acting now, you ensure that the retirement you plan for matches the income you deserve. Your pension is your right, your future, and your security. Don't leave it to chance. Check, correct, and plan today. This concludes the video. Following these steps will give you clarity, confidence, and control over your pension payments for the rest of your life.